Silicon Valley Bank Collapse. Welcome to our video discussing the nail-biting collapse of Silicon Valley Bank, a bank that has long been the darling of the tech world. As a financial institution that specializes in serving startups, venture capital firms, and other tech-focused companies, SVB has been a driving force behind some of the most innovative and disruptive tech companies of the last few decades. But how the unthinkable happened and SVB went bankrupt. In this video, we'll explore the potential causes and consequences of a Silicon Valley Bank collapse and what it could mean for the future of tech innovation. If you're excited to learn more about the world of tech and finance, be sure to show your support by smashing that bell icon and subscribing to our channel. Let's jump into today's video. A group of entrepreneurs in California's Silicon Valley faced a common challenge: finding a bank that understood their unique financial need. They needed a bank that could keep up with the fast-paced, high-risk world of tech startups and provide them with the capital they needed to grow their businesses. In 1983, that bank finally came into existence. It was called Silicon Valley Bank, and it quickly gained a reputation as a bank that truly understood the needs of the tech industry. With headquarters in Santa Clara, California, SVB provided banking and financial services to startups, venture capital firms, and other tech-focused companies. As SVB's reputation grew, so did its client base. The bank played a significant role in supporting the growth of many high-profile startups, including Apple, Cisco, and Yahoo. SVB's services included lending, cash management, foreign exchange, and corporate investment banking, all tailored to the needs of the tech industry. Over time, SVB expanded beyond California and into other tech hubs across the United States. But the bank's global ambitions didn't stop there. It opened offices in Europe, Asia, and Israel, expanding its reach and solidifying its position as a global leader in tech banking. On Friday, March 10th, a bank run forced the failure of Silicon Valley Bank after the U.S. Federal Reserve raised interest rates and one of the most prominent lenders in the startup ecosystem collapsed. Its failure is the biggest failure of a U.S.-based banking institution since Washington Mutual went bankrupt in 2008 at the peak of the financial crisis. As of the bank's most recent call report, filed on December 31, 2022, it had $209 billion in total assets and $175.5 billion in total deposits. Deposits at the bank increased from $62 billion in March 2020 to $124 billion in March 2021 as a result of the COVID-19 pandemic's impact on science and technology. The majority of these deposits were invested in long-term treasury bonds because the bank desired a higher return on investment than could be obtained from shorter-term bonds. As rates increased during the 2021 to 2023 inflation surge, the current market value of these long-term bonds fell, making them less appealing as investments. SVB's chief risk officer decided to step down in April 2022, and no successor was named until January 2023 during the timeframe of interest rate increases. At the end of 2022, Silicon Valley Bank had more than $15 billion in unrealized losses for securities that it planned to hold until maturity. This means that the value of those securities had decreased in the market, but the bank had not sold them yet. These losses were market-to-market, which is a way of measuring the current value of an asset based on the current market price. These investments are generally safe, but their value fell because they paid lower interest rates than a similar bond would pay if issued in today's greater interest rate environment. Normally, this isn't an issue because banks keep those bonds for a long time unless they need to sell them in case of emergencies. A journey of struggles with no end in sight. At the same time, as private financing became more difficult to come by because of high inflation, startup companies began to withdraw bank deposits to fund their operations. Depositors also had to withdraw from their savings due to a string of layoffs in the technology sector that started in 2022. At first, it was not a big issue, but as time passed, more and more nervous clients started asking for their money. Tension was mainly fueled by viral panic. that spread on social media, so the bank had to sell its own assets to facilitate the withdrawal requests. Customers at the bank were terrified when the disastrous bond sale was announced. They saw the bank losing a lot of money and wondered if this would cause its stock price to drop like a rock and possibly cause it to fail. An unusually large number of those depositors were corporations rather than individuals, and the majority had more than the legally protected $250,000 in their accounts. As a result, they rushed to withdraw their funds. Customers withdrew $42 billion from Silicon Valley Bank in a single day last week, leaving the bank with a negative cash balance of $1.8 billion. Federal intervention. The government eventually intervened. Biden administration announced on Sunday that all Silicon Valley Bank customers, whether insured or not, will have complete access to their deposits. It was a pretty bizarre move by federal officials to refinance billions of dollars in uninsured money, expressing widespread fears that the bank's failure would cause even more chaos. With one eye on the future and one on the incidents that contributed to the 2008 financial crisis, federal authorities announced on Sunday that they were taking emergency measures to prevent pandemic at other small and regional banks. Signature's downfall follows in the wake of the collapse of another crypto-focused bank, San Diego-based Silvergate, which announced last Wednesday that it had decided to close its doors and repay depositors. Bank failures are not uncommon, but none have occurred in the United States since 2020. Now, there have been 3 in 1 week, a frequency not seen since the 2008 financial crisis, government officials said in a statement issued on Sunday. Today, we are taking decisive actions to protect the United States economy by restoring public trust in our banking system. This step will ensure that the United States banking system continues to perform its critical roles of deposit protection and credit access to households and businesses in a manner which encourages strong and sustainable economic growth. Monday, President Biden said that his administration's actions had guaranteed that the banking system is safe. He repeatedly stated that no losses will be borne by taxpayers and that he will take steps to make sure that those responsible for this disaster are held accountable. But who is truly to blame? Depositors who failed to properly insure their cash and then panicked and withdrew their funds from Silicon Valley Bank before taking a moment to breathe? The bank's management for not being able to manage their bond portfolio as interest rates rose? The Federal Reserve for raising interest rates and depreciating most investments of the bank? What do you think? Let us know in the comments below. If you liked today's video, make sure to press the like button and watch another one of our videos on screen now.